Did you know that a $1 billion personal loan from a customer's money was taken by Sam Bankman-Fried? The FTX was valued at a shocking price of $32 billion. They never had a board meeting. There was no basic bookkeeping and there were no traces of employee records. Both the parents of SBF and employees of the FTX purchased properties that are worth $121 million with the customer's money. Hello there, this is Market Empire. In this video, I will be revealing about the shocking revelations from the filing of bankruptcy of the FTX. Let me get you to the details from a 30-page report. I just couldn't imagine how bad this is. I mean, it's really crazy because here's what exactly happened.
Reuters found that FTX, Sam Bankman-Fried's parents and senior execs bought at least 19 properties in the Bahamas over the past 2 years.
So billions of dollars were lost from the customers and investors of the FTX due to its collapse. The initial shock of the bankruptcy and its bizarre events lead up to had it faded. John Ray III, the new CEO of FTX, reviewed their finances closely, and what he found out was really surprising. It was so disorganized and basically it's a disaster. It was written in John's report that never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information, the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals. This situation is unprecedented. And that says a lot considering the 40 years experience of John Ray, in which was instrumental in resolving the Enron's bankruptcy of 2001. But this one is a different ballgame. Up to this day, FTX doesn't have any idea of how much cash they actually had on their hands or even how many individuals were employed. Let's walk through to the 30-page report of some of the most shocking revelations. Are you guys enjoying the video so far? Before proceeding, kindly hit the like button seen below your screens. Buckle up everyone, because things are about to get crazy. Number 1, payments were requested over chat from the employees. The payments would get approved or denied with just an emoji by a random manager. Mr. Ray wrote in the filing that the submitted payment request through an online chat platform and supervisors gave their approval by responding with personalized emojis. It was also said by Mr. Ray that homes and other personal items for employees were bought using the company's funds. And to Mr. Ray's knowledge, those were not recorded as loans. I will be talking about that in a few. Number 2, $1 billion personal loan from Alameda Research was received by Sam Bankman-Fried. Moreover, according to the Wall Street Journal, the FTX was able to raise $450 million from a number of investors such as Sequoia, SoftBank, and even Temasek. As reported by Sam, this was expected to help the firm grow and also to allow them to interact more with regulators. But the whole truth is worth $300 million was diverted to Sam. I mean, that's insane, right? Talk about deception and dishonesty when it comes to money. Number 3, it was said a while ago that FTX failed at basic bookkeeping. John Ray mentioned that FTX failed to keep their proper books, their records, security controls for the digital assets it held for consumers, they used software to conceal the misuse of customer funds, and it even gave a special treatment to Alameda's other customers.
Yeah, so part of the issue that John Ray, the new CEO, has talked about is how messy the accounting was. So keeping track of these assets, whether they're in Bahamas or in the U.S., and who has the right to really oversee those is one of the issues, and it goes back to the beginning days of FTX and sort of the mismanagement as John Ray has described it.
There were no accurate traces of the bank accounts of FTX or even the complete record of individuals who worked under FTX. He also mentioned that FTX used an unsecured group email account to manage the security keys for its digital assets. Most of the decisions at FTX Exchange were done via online chats. It appears that Sam encouraged the use of these messaging platforms because messages can automatically get deleted after a certain period of time. Number 4, the group FTX was once valued at a price of $32 billion and they never conducted any board meetings, which is definitely strange. This is like the Enron scandal back in the year 2001 for many. But the advisors of FTX Bankruptcy say that the collapse of FTX is way more worse than what happened at Enron. It showed that FTX's bankruptcy filing exchanges liability could reach up to $50 billion worth of liabilities. Back then, Enron only had $23 billion worth of liabilities. Upon seeing this might really be the biggest fraud case of all time. Are you guys still with me? If so, then consider clicking on the subscribe button so you can stay updated on our newly uploaded videos. Number 5, the cash flows of FTX were not kept in a centralized control manner. The management does not have any idea of how much they had available on hand at any given time, or even where it all went. The filings describe it the best. The FTX group did not maintain centralized control of its cash. Cash management procedural failures included the absence of an accurate list of their bank accounts and even account signatories, as well as their insufficient attention to the creditworthiness of their banking partners around the world. Under my direction, the debtors are establishing a centralized cash management system with proper controls and reporting mechanisms. Number 6, there were no accurate records of the employed individuals of FTX, and the worst thing is that no one really can confirm the existence of who were the supposed employees of FTX. According to the filing, some of them were fraud and likely imposters. Number 7, real estate was purchased through the use of corporate funds for personal use, and both the employees and executives benefited from the company fund to put their names on the homes they bought with the said money. Besides, according to recent news, parents of Sam and senior executives spent almost $300 million on luxurious residences located in the Bahamas for over the last 2 years. Now, if you think that those were all bad, here's something terrible. It was stated by Sam in September 2002 that the FTX held $5 billion in less liquid crypto tokens. The actual cost of it was around $695,000. Now, the one big question in mind that remains at this point is, how did so many of the clever minds still believe FTX? According to Fortune, aside from the financial sector being pushed by a frenzy of low interest rates and cheap money, investors would receive a good-to-pass-up paper from Sam. It was a spreadsheet containing the revenue, daily usage, and expenses. Alameda was left out. This gave them an idea that FTX was a quick developing company with a good financial record, with their sales rising from $15 million way back in 2019 and when it was founded in 2021 with $1 billion worth of money. In fact, these were sales with no legal sales documents or no actual accounting. However, it didn't really matter in the end since the investors saw cash signs and they were drooling over for a slice of the pie. Lawsuits are being filed against the FTX and the celebrity promoters. Some of the celebrities are Kevin O'Leary, Larry David, Tom Brady, Gisele Bündchen, Shaquille O'Neal, and even the great Stephen Curry. According to attorney Adam Moskowitz, a complainant, the FTX platform was indeed fraudulent and it is a castle made up of sand. In a Ponzi scheme where the FTX businesses shifted consumer funds between their opaque affiliated entities with the use of their brand new investor funds received through investments and even loans to pay interest to the old ones to maintain the illusion of liquidity. This clearly explains that some of the top celebrities were used by FTX, whether it is in sports and entertainment, to raise money and to get some Americans to invest in the Ponzi scheme. According to the information, other venture capital firms are taking into consideration in suing Sam. On November 20, 2020, Joe Biden called for changes to the rules with regards to regulating Bitcoin and other cryptocurrencies. In the meantime, hearings are scheduled to take place this December by the U.S. House Committee on Financial Services for the FTX catastrophe. A testimony will be provided by Sam Bankman-Fried. However, Maxine Waters, who will rule over the hearing, seems to be really tight with Sam. Last April 2022, both of them had a meeting before the crypto collapse. And among other things, this was to talk about cryptocurrency. But what about the potential corruption within the government itself? Besides, a petition has been started by lawyer John Deaton to look into the connections between Sam and the SEC head Gary Gensler. Recently, it was discovered that the two spoke to each other for 45 minutes last March to discuss this new trading platform that was slated for a SEC approval. People who have knowledge of the situation describe the activity as something odd. According to Fortune, Gary is in a corner. Moreover, according to Washington, D.C. insiders, he is waiting to be grilled by the Congress. Senior Democrats and Biden officials were also urged by Senator Josh Hawley of Pennsylvania to release the emails related to FTX, Alameda Research, and Sam Bankman-Fried. The aim is to see if Sam's $37 million of political donations to Democrats was used to put pressure on regulators to be more sympathetic with FTX. Do you think the victims can still get their money back? A lawyer at the New York legal firm Muchasi Frenchman, Robert Frenchman, said that FTX customers will have to get in line with the rest of the creditors because there are no special protections for customers of unregistered crypto firms like FTX. According to John Ray, who's looking into Sam's empire books, there isn't even a single document detailing all the company's depositors. So really, it's not looking great. Some people may get funds back, but it's likely to be sent on the dole. Eventually, texts between Sam and a Vox reporter have been exposed. Sam confessed that a dumb woke game we Westerners play when we say all the right shibboleths, and so everyone likes us. He said, F regulators, they make everything worse. Later on, he blamed his ex-girlfriend named Caroline Ellison, who's running for Alameda at the time. FTX didn't lose money. The money was loaned to Alameda and they lost it. Alameda had more collateral damage than what they actually had, Sam simply said. It's definitely hard to trust him, but even if we do, it is reasonable to argue that with having no accounting department, this may come in as no surprise for everyone. But where was his lawyer? Paul Weiss dropped him as a client after the collapse. And I can't argue more as to why he did it because it is nearly impossible to legally defend Sam right now. With Caroline's situation, there were several speculations that she's moving to Dubai, a nation without deportation agreement with the US. But no evidence was shown to support these claims. This is how Sam Bankman-Fried's multi-billion-dollar house of cards FTX actually went on for years. If you guys enjoyed this video and left you in awe, make sure to give this video a thumbs up and click the subscribe button below to keep you updated for our upcoming videos. Stay tuned, everyone!